it is going to be that. In order to do that, use my free calculators to work out where you are, where you need to get to. The reason most people don't do this is because there aren't free tools available which are simple and easy to use, and that's why we created them. If you want to learn more about all of this, and there's a Google Drive with all these files on it, just go to upshell.com prospect. I know there's tons and tons of information I'm throwing at you here, and there's a lot I'm telling you to look at. But seriously, it is good quality stuff, and that's why I'm telling you to do it as well. Okay, there's a bunch of files that I want to, for those who are on the webinar, I'm just going to share with them, including one on conflicts of interest that exist in the industry. The IFA has a conflict of interest in that they will not tell you when to go into cash because they earn less fees. So if there are times when you should be holding cash, they won't tell you. They also have a conflict of interest in that they can only put you in things which are in front of them. So they're often tied. And the way they hide the fees is they'll say, oh, you're going into this St. James's Place Master Fund. And what they don't tell you is that fund is then investing in a bunch of other funds under it. Okay. And because of that, what ends up happening is you think you're only paying 0.5%, but the funds that they're putting it in, which are their own company funds, it's called vertical integration, means that you're actually paying them a hell of a lot of fees hidden in a lower layer. Now, what's going to happen with the falls? There are two types of falls, and there are two types of actions we can all take when the market inevitably falls, because it always does. The two types of falls are long and drawn out, and the opposite is short and sharp. Okay? Now, we don't know which of those two categories it's going to be. Listen to this. We've simplified this into the simplest logic that anybody could understand, and it's very easy to understand as well. Okay? You don't know if something, let's play a game. You don't know whether something's going to be long and prolonged, a long bear market like 2022, or short and sharp like February to April 2025. Now, if you don't know which one of those two it is, the only thing you can go by is your own appetite for risk, which is a question of something you might have to meditate yourself on. All I know is most people think they've got a bigger appetite than they have. So if they think out of a score of 0 to 10, they're a 7, they're usually a 5. Now, what you can do in that scenario is this, and this is the smart move, and it's to do with game theory and all the rest of it, is this. You can work out, are you risk averse or risk loving? And you can say,